It began with a rupture so violent, so financially obscene, that even the most desensitized American investors who had watched fortunes vanish in the dot-com implosion of the 1990s, who had survived the housing collapse of the 2000s, and who had endured the crypto detonations of the late 2010s, suddenly found themselves staring at their screens in disbelief. A United States fintech, Circle Internet Group, under the ticker CRCL, entered the New York Stock Exchange on June 5, 2025, with a regulatory pedigree so clean that the opening weeks should have been calm, orderly, almost boring. In a normal cycle, a company like this stabilizes near the offering price, institutions accumulate over weeks or months, the valuation moves in measured steps, and the narrative unfolds with predictable logic. But CRCL's trajectory detonated that expectation. The stock blasted from its IPO price of roughly $31 to nearly $300 within days. Moves like that do not happen under ordinary market physics. Under usual circumstances, such a surge would require either a speculative mania, completely detached from fundamentals, or a sudden recognition that a company sits at the center of a new financial architecture so transformative that the market reprices it instantly. Before investors could decide which explanation made sense, the price reversed violently. By late November 2025, the stock had collapsed into the low 70s, even though Circle was reporting accelerating revenue, expanding margins, surging USDC circulation, rising institutional adoption, and the strongest regulatory tailwind the stablecoin sector had ever seen. The contradiction became impossible to ignore. Growth companies that deliver stronger fundamentals quarter after quarter do not normally lose more than 2/3 of their value in a matter of months. CRCL did, and it did so while its operational performance strengthened. That inversion is the core of the mystery. To understand why the anomaly carries so much significance, we have to understand what Circle Internet Group actually is. Circle issues USDC, a fully reserved stablecoin backed one-to-one by US dollars and short-term treasuries. In traditional finance, this type of synthetic dollar is considered the safest architecture for digital money. There is no leverage, no fractional reserve behavior, no hidden credit exposure, and monthly attestations verify the backing. Under typical regulatory logic, an issuer following this blueprint is treated as low risk, and the regulatory environment in 2025 was not merely supportive, it was the most favorable stablecoins had ever seen. The Genius Act advanced through the United States Senate. MiCA went live across Europe. Regulators in major economies converged on a single requirement. Stablecoin issuers needed fully backed reserves, transparent disclosures, and conservative operating structures. Circle matched that model perfectly. Many analysts even remarked informally that the legislation looked like it had been written with Circle in mind. Adoption data reinforced this alignment. By mid-2025, USDC's circulating supply expanded roughly 70% year over year. In late October 2025, JP Morgan published an analysis showing that USDC had overtaken Tether in real on-chain economic usage. That shift was far more than symbolic. It meant institutional treasuries, fintech platforms, and global payment processors were beginning to embed USDC into their settlement flows. Under normal market logic, a product becoming financial infrastructure signals that the issuing company is entering a structural re-rating phase where valuation multiples expand over time. The financial performance supported that view. In Q2 2025, Circle generated around $660 million in revenue, more than 50% higher than the previous year. In Q3, revenue accelerated to roughly $740 million. Net income surpassed $210 million. Adjusted EBITDA margins held above 50%. USDC circulation rose past $73 billion. These are not metrics of a speculative fringe fintech. They are the financials of a company evolving into a global settlement layer. Yet CRCL's stock price declined as if the opposite were true. After Circle released Q3 earnings after the market closed on November 12th, the stock fell about 16% almost instantly. Over the following month, it dropped more than 40%. That is deeply abnormal behavior for a company delivering upside surprises. Usually such a beat triggers positive moves or at worst temporary consolidation. Investors began searching for rational explanations. The first was Circle's operating expense guidance. Full-year expenses were projected near $500 million. Normally, rising expenses in a scaling infrastructure company are seen as natural and even healthy. They reflect engineering expansion, compliance build-out, global connectivity, and deeper settlement routes. Under conventional investor psychology, these expenses are interpreted as investments in future dominance. But CRCL had already run nearly tenfold. Expectations had drifted too far ahead of fundamentals. When a stock is priced for perfection, even minor cost increases can produce disproportionate downside. The second explanation was the December 2nd lockup expiration. Lockups normally cause brief dips as insiders gain the ability to sell, but CRCL insiders held shares that had soared dramatically. Markets feared powerful selling pressure. Again, this was rational but insufficient to explain the sustained decline. The deeper mystery appeared when analysts studied Circle's revenue engine. Because Circle earns most of its income from interest on reserve assets, its profitability is tightly tied to short-term U.S. interest rates. In 2025, those rates were elevated. Under normal financial conditions, this environment should lift Circle's earnings. Q3 results confirmed this strength. Yet the stock acted as though the revenue engine was deteriorating. It wasn't. This widening gap between improving fundamentals and falling valuation is extremely rare. In efficient markets, such divergences usually narrow quickly, but here the divergence expanded. That expansion signals that non-fundamental forces such as investor psychology, unfamiliarity with hybrid issuer models, or structural confusion are driving valuation rather than underlying performance. Circle's hybrid identity intensifies this confusion. It operates as a payments network, a reserve custodian, a regulatory-aligned settlement layer, and an infrastructure provider all at once. Traditional equity valuation models built for SaaS providers, banks, or exchanges struggle to price such hybrids. Investors unused to modeling reserve yield mechanics may undervalue the predictability inherent in stable reserve income. The result is extreme volatility despite strong numbers. Technical indicators captured this tension. By late November 2025, CRCL hovered near $72, slightly above its 20-day moving average, well below the 50-day and far beneath the 100-day and 200-day averages around $85 and $110. The MACD remained firmly bearish. The RSI sat near the low 50s. Historically, this combination shows a market suspended between opposing narratives, waiting for a catalyst to choose a direction. This unresolved tension matters because Circle sits at the center of a global shift toward transparent digital value transfer. If USDC adoption continues rising and regulators continue favoring fully reserved models, Circle's structural importance grows. As it grows, the current valuation disconnect becomes unsustainable. Eventually, either price must rise to meet fundamentals, or fundamentals must fail to justify their trajectory. At some point, one side breaks. In the near term, strong support sits in the mid-60s. If CRCL breaks below that region, downside pressure may accelerate. Immediate resistance appears in the mid-70s, and stronger resistance near the mid-80s, where the 50-day and 100-day averages cluster. Without reclaiming those areas, vulnerability persists. Over the medium term, a move into the upper 80s or low 90s would signal recovery. Over the long term, the decisive reversal requires reclaiming the 200-day average around $110. Only above that level does CRCL transition back into a structurally bullish posture aligned with its fundamentals. The long-term story remains intact. USDC adoption strengthens, regulatory clarity improves, institutional flows accelerate. Circle's revenue model holds steady. Nothing in the operational data suggests deterioration. The mystery is not whether Circle deserves a higher valuation. The mystery is why the market has delayed acknowledging that reality. That delay creates an unstable equilibrium that history shows cannot last. When it resolves, the outcome will define CRCL's next era. And by the way, if you, the listeners of ValueStir, know any listed or unlisted or soon-to-be listed stocks or coins that deserve deep investigation, then tell us and leave them in the comments, because your tips shape what we explore next, and your ideas keep this channel alive. And to all of you who watch, subscribe, like, comment, and share these episodes, we appreciate your dedication, and we will return that dedication with even better content. This was ValueStir.